Basically, that's what the market is. It's an auction. I started in 1977. I'm showing you some snapshots of the floor because this is the Eurodollar pit. Currently, there's 7 traders left, 8 traders in the pits. So take a look at it. That's how it looked back in its day. I spent 25 years on the trading floor, and actually, I wish it was only 30 years, but it's actually been 35 years since I started the business. Started in 1977. So I watched all the changes. Here you're looking at a shot where the E-minis started to trade with the bigs. You see the S&P pit, and you see all the screens around there. Those are Globex machines. And members were trading, trying to catch the spread between the E-minis and the big contract. I just thought this is always fun to take a quick look. Here's a snapshot of the S&Ps. Pretty crazy back then. But, you know, the floor is pretty much gone. Everything's electronic. And the only thing that I can take, there's only a handful of things I could take from the floor. Trading electronically is a different feel. It's a whole different animal. But what both have in common in the market in general is I want to simplify things for you to really get you back down to ground zero to, you know, what we're doing here when we're trading. So the trading is basically an auction, okay? So I put this up here. You know, the marketplace is purely an auction place to find fair value price for the product that is being traded. And that's what we're doing, right? The market goes up because they feel they got to move the prices should be higher. You know, there's, you know, not as much inventory above, so the market will move up, you know, to take out the inventory if they feel there's more value on the upside. Same with the downside. So the market itself, let's talk about the market. I mean, let's simplify it. Because, you know, what I find is that I came from the floor in 1977. So I started trading as a member at the Mid-Am Exchange in 1979. They're using a chalkboard to put the quotes up there. So there's been a big change, you know, that I watched all my years. But there's something that really we have to remember. It's, you know, if you keep it simple and you take away all the, you know, too much of the analytical, you know, stuff that we get bombarded with, and first try to remember what the market is and who controls it and what makes the market go up and down. I'm going to break it down for you a little bit. We'll talk about, actually, this is pretty much from Peter Stottlemyre, if you've ever studied market profile. So, you know, there's 2 types of participants in the market. Market's controlled by 2 types of traders. The long-term trader, that's the hedge funds, the institutional type players looking at a higher time frame to reach their profit targets. These traders, they're not interested necessarily in buying 1,000 E-minis and then scalping it for a tick or 2. That isn't really what's going on. These, you know, the big institutional hedge funds, they're looking at higher time frames, you know, daily, weekly, looking for maybe a 2-day move, a weekly move, a monthly move. They're the hedgers that, you know, let's say, you know, the farmers, for instance. I mean, they're looking 3 months out. When they get in, they got to get in. Those are longer-term time frame traders. The institutional funds, the funds that are hedging against whatever it might be, you know, if it's an oil company, they might be even hedging their oil. But then you have the index funds. The index funds, you know, when they come in, they have to shorten up their imbalances, if they have any, and make sure they're in the market based on the amount of money coming into the index funds. So the short-term traders, basically, I would say everybody that's on this site, we're short-term traders. You know, you might be longer time frame, meaning that you take it for a day or 2 or 3, but really I don't, I'm a pretty big trader in respect to others, but I'm not that big. Linda's a big trader, but compared to big institutional funds, we have some clients that will take a 4 or 5 thousand lot position with our firm for 3 or 4 days. Those are the longer term traders. The short term traders are the day traders, black box. The company that my last partner in this firm actually was the founder of Getco, if you look it up. But those are short-term traders. They're in for like seconds. The market makers, the black box market makers, the system traders that are just scalping. So members from the floor, those are short-term traders. So now let's keep it simple for a second. You have the long-term traders and the short-term traders. Based on that, we have to determine at the moment that we're trading, or based on at least the opening couple hours, to see who's got control of the market. That's going to be a big help with determining if you're going to be buying breakouts or you're going to be selling rallies and buying dips. So let's go to the next slide. Now I'm just going to touch bases on market profile. That's a whole other system, and there's a good chance that probably only 10% of listeners have used market profile or studied it. So I'm not going to get deep into it. That's a whole other class. Photon Trader is the front-end system that we own and that we use, and this is just a snapshot of it. But I wanted to show you something about what we're talking as far as short-term and long-term traders. So if you were to do a distribution chart, that's what this is, market profile. Peter Stottlemyre actually created the distribution chart called market profile for futures. But distribution charts have been around a long, long time. They date back in the 1800s. And it basically was created to see where most of the activity is taking place. In this case, this is a futures market. This yellow means that all these are time brackets, Q, R, U, V. Could be a 15 or 30-minute chart. And every time a price trades at, during that time bracket for the first time, then a letter is put there. I'm not going to get deep into it, but this here is what a short-term trader, a market that is controlled by short-term traders. It will resemble some kind of a bell curve, okay? This here is the point of control where the market traded the most, and this is considered the value area, which is where 70% of the trading has taken place. I'm not going to get into market profile too much, but we'll get into how it looks on bar charts so you can understand what I'm talking about. But generally what this means is that the short-term traders have control of the market. Long traders aren't in there to drive the market to a new distribution area or a new price level or create a new value area. Here's a typical day where you can tell that there had to be good buying. There had to be long-term market makers in the market to push it from the early morning opening all the way up to here and move the point of control. And you can see there's like two big bell curves. So basically, they move the value from here up to here, and this was where the new value area was created. And there's the point of control. Just a little quick peek at market profile. And I know we only have 20 minutes, and it's kind of hard to cover too much, but I want to give you a snapshot. We'll be doing more videos or webinars in the future, and we'll be working with TradingPub very closely. So if you're interested in any education from myself and Linda, keep an eye, with TradingPub to see what upcoming webinars might be available. So let's go to the next chart, or let's just go to the next slide. So another way to confirm if the longer-term traders and shorter-term traders have control of the market, it's very much about volume. I mean, that's a good way to look at it too. When you see new highs being made, for instance, and maybe the volume in the E-minis, let's say, on a brand new high, you only see 200 or 300 cars traded up there. It's obviously that the long-term traders have not participated on the new high. But if you go to a new high and you see that there's 4, 5, 6,000 traded on a brand new high, even if we made the high and we pulled back, that's going to tell you that there could be some more buying around the corner. Usually institutions don't come in and just bang it out, you know, in a minute or two. For instance, when I used to fill for the Ridex funds on the floor, if I had to buy, let's say, 3,000 big S&Ps, that's the equivalent of 15,000 E-minis. There's no way I'm going to blast them at one point. I'm going to buy 500, buy 200. I'm going to farm it out and feed it to the marketplace so that I don't move the market too much based, on my buying alone. So that's a good way to spot if the longer term traders are in the market. I could tell you when I was on the floor of the exchange, I knew that I was in trouble if we took out a high and I can hear myself bidding. That means, okay, I'm in trouble. So I'm turning around and hit the first bid. And that's generally just a little bit of an idea that the longer term traders weren't there. Now, if we took out the high, and as I'm bidding, I can hear Goldman or I can hear Morgan bidding for 1,000 or 500 or 600 behind me, and the whole pit's bidding. Then you have a little bit company. Then possibly the market is going to continue above that high, and you don't want to sell it on the new high. You don't want to fade it. You want to go with it. Or if there's a pullback, you want to be buying it. So, so basically, if you look at this, these four things, volume confirms breakouts from chart patterns in a manner of traditional technical analysis, right? If the day has light volume, there are odds that the short-term players have control of the market, and it's going to be hard for the market to go and continue and sustain a new high or low. High volume days tend to trade sideways, and that's because the short-term traders aren't in there for a long period of time. They're looking for 5 or 10 ticks. They're on a 5 or 30-minute time frame, and as soon as the momentum stops, they turn around and cover. On large volume days, the last hour can be very forceful, and that's what I'm going to get into is the index fund buying a little bit. We'll talk about that at the end of the presentation, because that's what I did on the floor, and it's really something that probably no one's ever talked about, because you'd have to have been on the floor to fill for these institutional funds. Okay, let's move a little quicker here. What you're looking at here is just so you don't look at this chart and go, well, what is this? Photon Trader designed a volume candle chart, and for the purposes of not having to look on the bottom and try to measure volume on a new high, what this is basically a 5-minute chart, and the candles will widen as the volume gets bigger. So you can see if there is really going to be follow through on a new high. And what you're looking at here, when the market went up, there was no volume on that spike high. The bars are very thin. You got a spike high, which and everybody knows what that means. I'm not going to swear on the video, but basically, if you bought it up here, you're screwed, basically, right? There's no volume. That's me bidding on the high, and I can't hear anybody else. I can hear myself. So the market reversed, came back down, a retest again with no volume, and that's when the market started to deteriorate. Meanwhile, the market, if you look at this chart, is in a big consolidation pin, failing on the high, failing on the low, coming back and forth. The only way that the market's going to come out of this is if it has increased volume. The longer term players come in and they pick a direction with volume and increased volume to take it to a new value area. So consider this a value area. The reason why I showed you market profile, it's more about the concept. You don't have to have a market profile. But the value area here, basically, the concept is that traders are comfortable trading within this area. You see that you can almost draw a line through there. So when it came out of this consolidation, the value area, if you want to call it, look at the volume that increased as it came out, and the increased volume until finally the volume subsided and the market pulled back. Now, in a case like this, I actually did this chart, and then I did a follow-up chart later because I was trying to actually show how it developed. So if you were buying on this area here and you see the volume, you can be assured that the volume is going to continue higher. Once the volume started to decrease and you reverse, you can take your profit, but don't look to get short on this type of breakout. Look to buy the dip. So now let's look at the next chart. This is the same chart, and this is what happened. Market felt, rallied. Then you got a bit of increased volume on the downside, probably longs covering. But here's the support area, and this is what you should be looking to be doing. Stottlemyre basically, considers this the value area. And when you come out of the value area with increased volume, that's when the longer-term traders are in control. So now on the pullback, you would be looking to buy this dip. If there was no volume here when it came out of this consolidated area, or as we say, the value area, then that's when you can fade it, or that's when you can sell a reversal. But if it comes out with good volume, you want to be buying the dip on the next support area. Is everybody getting this? Just say yes, no, jump in the lake. All right, am I pretty clear though as far as what I'm saying? Okay, I'm trying to really move quickly here and try to fit 34 years of experience in 20 minutes, and I'm not a magician, but I'll try. So here's another chart, just another example, like a double top. Let's just talk about volume in general. This is a photon chart again. You can see the candles get bigger as the market, the volume picks up, right? So you can see on this move up, we had increased volume, but then all of a sudden we get this spike with no volume. Little consolidation, and then dog pile out, every long start to cover. Retest again. Here we go. This is no volume on this retest. And you can see what happened. Bigger volume on the downside. So probably all the longs that were stuck long still in here got out, could not rally even close to what I call the pocket, and we'll get into that another time. But this area below this area couldn't even, it retested it, and then the market fell apart. Okay, so this volume in general is just a good way to see if there's going to be follow through. And you can use all your other indicators, but confirmation is very, very important. And Linda will talk about a lot of that stuff, I believe, too. If not, she's going to hit me in the head. Okay, so let's go to, this is also a photon. I used a black background just because some are used to black backgrounds. And I threw this chart up. This is actually just recently. This might be a day old. I tried to throw some recent slides. So here we are. We have this big sideways volume, or chop, if you want to call it, but creating short-term traders are trading back and forth. This is the kind of like the value area. You can kind of draw it within. Use your own imagination, based on tops and reversals. You can see here on this one. This was about 3 days ago when we came out of here. There was no follow-through because you see there was no volume. The long-term traders did not believe there was value up here to come in and buy it. And you could see the increased volume coming right back down. This is telling you that, okay, the downside is favored, less value, too much overhead inventory coming into the market, and you can see the market selling off. So when you see this increasing in volume going through support, that's telling you that you want to be looking at the downside and selling rallies. So what do? If you didn't catch this, wait for the pullback and then the reversal, and you get short. Pullback, reversal, and you get short. Because this is telling you, they're looking to move the market to a new value area. This is, oops, I didn't really size this. I cut off some of it, but here's just another example. If you're looking at a trending market and the trend is down, looking at volume once it breaks a previous low to increase, then you can have continuation of the downside. Market kind of dribbled down, had a good amount of shorts get in here. Are you guys seeing it? Somebody said they're not hearing or seeing anything. Okay. So anyway, again, we pulled back up to this big breakout area. And what happened, the market, I cut off this slide. Sorry about that. You can see I cut it off. But basically, the market dribbled right back down. So that was a nice pullback. Okay, I got a couple minutes. I'm going to pick this up real quick. Here's a market profile, a bigger picture. Every one of these represents one day. Here's a consolidation period, and here's a typical day when the institutions came in, took it out of the value area, the consolidated area, and brought it and created new value up above. This is a day that longer-term traders have control of the market. Real quick, this is how a bell curve or a market profile looks on Photon if you were to make it into a bar chart. That, I believe, will translate to most traders that are on here a little bit better by looking at the bar chart formation. But you can see the bar chart here. When we came out of here, we had lower volume in this new high, single prints. What did it do? It pulled right back down to the value area. Okay, I'm kind of speeding this up. Okay, I got 2 minutes, I think, right? Oh, I'm over. Okay, take a quick peek. This is end of the day index funds coming in, and you can see when they're coming in. I do a whole seminar in this, and I might do a trade the last half an hour with me. Everybody's trying to get me to do that. We'll see. Keep your eyes on TradingPub. But here's an example where we had consolidation after a big up move, and then at the end of the day, the last half an hour is where index funds have to do their shoring up for their imbalances. And you can see that here. This is right before the last half an hour. No trading hardly above 30 contracts. This is what it looks like the last minute before the 3 o'clock close. You can see this kind of activity will happen the last half an hour. You can see the size, the bid and offers, how big they are compared to here. So I have to get out of here, otherwise my wife's going to hit me over the head. Here's some information. If you have any questions, you can contact me directly by email or by phone or through TradingPub. Future Path, real quick, is an IB, is a brokerage firm. We cleared 6 different firms where we have very good pricing, and then Photon Trader is our front-end software that we use. That you just noticed that I put up. Okay, hang on 1 second. I'm going to get Linda here ready. So, all right. I'm going to switch over Linda. By the way, Linda is my wife, Linda Reschke. I know, I couldn't punish her with my last name, Pavlatos, because no one gets it right anyway. So, if you have any questions, again, contact me. I'm going to give you to one of the best traders I feel around, not just because she's my wife. But good luck, and if you have anything, please feel comfortable to contact me. Thank you.